Good morning. You are watching a live market outlook for Friday, 17th of February 2012, prepared by Windsor Brokers. The broadly positive sentiment returned to the markets after yesterday's strong bounce of euro, British pound, and most of the risk correlated currencies, as well as commodities, on some again positive news from Greece. Maintaining this positive sentiment overnight and setting potential for a further reversal and possible end of this short-term downtrend that was seen on euro and cable. And yesterday's bounce higher raised most of the recent losses in the past 2 days. The crude oil is again back above 102, attempting towards 103 level, while dollar appreciated further against Japanese yen and broke above initial barrier at 79.00, now opening way towards end of October post-intervention high at 79.50 zone. Euro is steady this morning, and it's well above 3-week low at 129.73 that was hit yesterday, as headline watching markets turn more optimistic. A bailout deal for Greece will be secured soon. More details about this is given as optimism is growing that Greece has finally done enough to secure a second bailout after it set out extra budget savings, but the moves failed to ease tension with the EU paymaster Germany. The time is running out for Greece to seal 130 billion euro rescue and avoid bankruptcy, but Greek officials hope Eurozone finance ministers will sign the deal off on Monday, a month before Athens needs the money to make 14.5 billion euros of debt repayments that come due on March 20th. The optimism followed the acrimony between Athens and the northern states in the 17-member currency union led by Germany, and came only after a proposal to withhold part of the bailout until after Greek elections expected in April was dropped. One of the Eurozone officials said that we are almost there, expressing hope the deal could be done with when ministers of the Eurogroup meet in Brussels on Monday. Unless someone really comes up with an idea to undermine the whole deal, it should be approved on Monday, he said. So some positive tones again are seen in the markets, and we hope that the final decision and the deal will be reached on Monday to avoid quite catastrophic reaction in case of Greece going into the bankruptcy that would trigger a worldwide crisis, and with the results of this still not being measurable of the possible impact of on the world economies. Today is, as we said, Friday, last day of the week. Brief look at the calendar today. German PPI came already out at 0.6% higher than forecast, and higher than the previous release at minus 0.4%. Significant from Eurozone release of Eurozone current account that is due at 9 o'clock GMT. And the increase to 2.3 billion surplus is forecasted for today, compared to the gap of minus 1.8 billion euros. UK retail sales are expected to go into the negative territory. Minus 0.3% is the January's forecast, compared to the December's positive one at 0.6%. Across the ocean, Canadian CPI due at 12 o'clock GMT, expected to come at 0.3% compared to minus 0.6% in the previous month. Core CPI also monthly is forecasted at 0.1% versus minus 0.5% of the previous month release. Canadian leading index is due at 12 at 13:30 GMT. With the consensus for today 0.6% compared to 0.8 of the previous release. US inflation due at the same time at 13:30, 0.3% is the forecast for today compared to unchanged one in the previous month, while core CPI is forecasted at 0.3% compared to 0.1% of the previous month. US CB leading index due at 1500 GMT, 0.6% is today's consensus versus 0.4% of the previous release. That would be all from today's calendar. Now we are going to take a look in the markets and see the latest movements in the markets, as a quite significant action was seen in late hours of yesterday during the US session and the Asia. Starting with euro, after hitting a low at 129.73 yesterday, which also marks 38.2% of the entire short-term uptrend from 126.22 to 133.20, where the dips, where the rally was capped by 90 days moving average. The pair bounced strongly yesterday. Clearing first the initial barriers at 130.80 and 131, also breaking above the channel resistance and retracing slightly over 50% of the down move from 133.20 down to 129.73, with the yesterday's peak at 31.58, so far the highest level after hitting fresh low at 129.73. The structure remains positive now and sees scope for further extension higher, as break of 131.58 high would expose next level at 131.90, which is the high of 15th of February, also 61.8 Fibonacci retracement ahead of next barrier at 132, 132.14 and 132.30 previous strong resistance zone, above which to likely refocus recent highs at 132.82 and 133.20, and signal an end of corrective down move from 133.20 to 129.73. Current move higher and firm break above 50% is also expected, is required to confirm the near-term bottom at 129.73 and open way for a further extension higher. On the other side, failure to regain the next levels at 132 zone, my risk lower top and the further extension to the downside, further extension of the downtrend despite breaking above the channel line. However, at this point, the positive hourly and 4-hour structure keeps the focus still higher. Only loss of supports at 130.80 and 130.50, whereas 131 and 130.80 would weaken the structure, while below 130.50 would turn the focus again lower. On the 4-hour chart, we see that 20 days moving average currently at 131.00 holds the downside, and the dips are expected to hold, as the pair showed no significant corrective action so far after yesterday's strong rally, but only a narrow consolidation of the rally that gives a signal for further extension higher, as the hourly 20 days moving average currently at 131.10 maintains the latest rally. Similar picture seen with the cable attempting to create a double bottom at 156.50 zone, lows of 14th and 16th of February, as the rally extended gains to 158.16 so far, just ahead of our next barrier at 158.26. This was congestion on 13th of February, where the pair failed to clear the trend line and extended the down move from 159.26 high, finally attempting to base at 156.50 zone. The current bounce shows that the pair has so far recovered exactly 61.8% of the entire downmove from 159.26 down to 56.43 low 14th of February, keeping a scope for a further extension higher. Corrective action is seen as the hourly studies are pointing lower of the overbought territory, and the MACD is also breaking below its signal line, so we might see some, as well as loss of momentum, we might see some corrective easing preceding a current rally. It's important that initial supports at 157.35 and 157.20 hold the downside, hold the dips, and with 20 days moving average also at 157.20. That will keep the near-term bulls in play for a possible fresh attack higher, and attempt at 158.26, 158.50, and 158.84. Our next obstacles on the way towards key barrier at 159.26, the high of 8th of February, where 200 days moving average limited the upside. It's important on the wider picture break above 200 days moving average to signal fresh extension of the short-term uptrend from 152.33 and the refocus levels at 160 and the previous highs at 160.90, 160.29 and 161.29 and 161.29. That will be in focus on firm break above previous high and the 200 days moving average. For now, the 90 days moving average on the daily chart currently just below 157 handle holds the downside. The dollar against the Japanese yen is in a steady uptrend after finding bottom at 76 zone and also breaking above some important levels on the upside, clearing 78 zone, which is 200 days moving average, and a strong barrier at 78.27 range ceiling, and the congestion of November and December, also 25th of January peak, and regaining our initial barrier at 79.00. This is the peak of 1st of January, just after the intervention of 31st of October, when the pair rallied from 75.56, its record low, peaking at 79.52. The 79.52 is currently in focus as the pair continues to rally higher. Some congestion, some consolidation might be seen as the hourly 4-hour studies pattern are overextended, as well as hourly that might see some corrective consolidative action before the fresh rally. On the downside, the 78.80 and the 78.50 zone offer initial support and is expected to contain potential dips lower and keep the recent strong uptrend in play. Clearance of 79.52 is to extend the recent gains and look for a test of the next barrier at 80 and 80.23, peak of 31st of August, break of which might signal break above the past few months, actually from end of July 2011 range, where the pair was entrenched in past couple of months. Significant is attempt at weekly 55 days moving average at 79.15. That was already dented with the break higher to keep the upside in focus and look for test of 80.00 and 80.23 as initial targets. Dollar Swiss again lost the traction after a steady rally from 90.87, 91.00 support zone that cleared the initial barriers at 92.50, the previous range ceiling, and breaking above these levels, but gains stalled at 92.98, just an approach on our next target at 93.00, and the sharp reversal under 92.00 hit 91.73 and turn the near-term focus lower. As we can see, the hourly studies are in the negative field, and see potential for further extension lower as 20 days simple moving average on the hourly chart keeps the upside limited for now, as this morning recovery attempt was short-lived. Immediate support downside is 91.73, the low of last night, ahead of 91.50, 91.40, and then finally 91 and 90.87. Break below 91.00 is to end 90.87, the false break on 9th of February, false break below 91.00, and failed attempt to extend the broader downtrend from 95.93 would actually signal an end of this corrective phase and signal further extension of the downtrend from 95.93 with the 90.75 Fibonacci level to come first, ahead of with also the Ichimoku cloud base, which is currently at 91.77, pardon. That would signal the extension lower, and a possible test of 90.00 as the next target. On the upside, only regain of 92.50.60 would ease the current bear pressure. However, break above 93.00 is now required to resume the near-term uptrend from 90.87 and 91.00, and possibly attract levels at 93. The next target at 93.38, high of 25th of January. Also 50% retracement of 95.93 to 90.87 down move. From commodities, a brief look at gold, that is back to strength. However, the wider picture, the short-term price action is still within range, and the sideways movement. Yesterday's weakness found support at 17.05, which is the level of the previous low, and bounced strongly higher, approaching the upside barrier at 17.37. Yesterday's in our one of our updates, I mentioned that a regain of 17.37 is required to avert immediate downside risk, as the pair, despite being within the range, wider picture still shows the tone is slightly skewed towards the downside of 17.63, high of 3rd of February. Break above 17.37 is to signal double bottom at 17.05 zone, and look for test of our next significant barriers at 17.52, 17.50 zone, ahead of the next significant at 17.63. This is the peak of 3rd of February. On the wider picture, the structure remains still positive. However, loss of momentum might put additional pressure on the yellow metal. We need to see a gain of 17.63 previous high in order to resume the uptrend from 15.22 low of 29th of December, and possibly to reattract 1800 as our next target. On the downside, loss of 1700, our initial support, would be risky for further extension lower, where the 90 days moving average comes at 1687, ahead of 55 days moving average at 1669, and the most significant 200 days moving average at 1661, loss of which would definitely signal further weakness and extension of the broader downtrend from 1920 record high of gold posted on 6th of September 2011. The crude oil is back to strength after congestion between 100 and 102.52 was broken on the upside, and the fresh rally so far hit 102.93, resuming its bull channel of 95.43 low of 2nd of February. The positive studies see potential for further extension higher. On the 4-hour chart, we're already in the overbought zone. That might suggest some corrective action. On the downside, immediate support is 102.50 previous high, and 102 level. while loss of 180 and 160 zone would be risky for a deeper reversal. Below $100 would put aside the recent bulls in favor of deeper correction. On the upside, focus is at 103, and our main target at 103.72, a high of 5th of January 2012, and it's also marking the yearly low so far. Good luck.